How are you, folks? Enzo Di Costanzo podcast, and today we're starting the second lecture for the Federal Open Market Committee, the Federal Reserve, or the central banking part of the courses for the graduate students for the 622, and for my those morning undergraduate sections. Okay, so let's hit this and let's start the Federal Open Market Committee notes. We've had an eventful week this week, obviously, with the several bank failures and we can certainly talk about that a little bit, but certainly the Treasury, the Federal Open Market Committee, the Deposit Insurance Corporation, three governmental federal groups are hitting what's going on. Okay, and I didn't. There's no FDIC lecture in this because I prepared it before the Silicon Valley Bank and the Signature Bank, and there's a third one. I forget the third one, but there's a third one that failed also. And I've been heavily getting the notes together. Republic First or First Republic, and then comparing the regional banks to the bigger banks. The four major ones are Bank of America, Wells Fargo, Citigroup, and of course the diamond of them all, the J.P. Morgan Chase version of banking. So, we have four very strong banks. Those are the top four commercial banks in the country, and they come under the supervision and regulation of the Federal Reserve System. Okay, the local and certainly the national, versions of the regional banks, and certainly the national versions of the banks, or the international versions of the banks, and the business that they do in America. So let's start with the Federal Reserve System, which again has a catchy title here for our particular country. Most countries, it's the country's name, the whatever the Bank of England, the Bank of Japan, they have fancy names. But if you go to whatever Romania or something, or Malta, it's the Malta Central Bank, or the Italian Central Bank, or the German Central Bank, or whatever. No, actually, no, the German Central Bank. The big countries have this like a catchy name. We have like the sexiest one, the Federal Reserve System. It's the U.S. Central Bank. In Africa, they say the Kenya Central Bank, the Nigeria Central Bank. That's how they refer to these things. It's the central bank of the United States. It's arguably the most powerful financial institution in the world. Maybe it was founded to provide the country with safe, flexible, stable monetary and financial system. So the financial system is what you see in terms of loans and credit. Certainly banking is out there, and the money supply. Well, the money supply starts the monetary system. You start to get into the when you start talking about money supply and interest rates, it becomes the monetary system. Spending is the financial system. The monetary system is the supply of money. Safe, flexible. I looked up a couple places. The financial stability. I looked up the IMF's definition, the World Bank's. So I went through a couple definitions of what financial stability is, and everybody has it. I don't have the lecture would go on and on forever, but one of the lectures will go through some of the definitions. But basically, the phrase that sticks in my mind is, when you go to the bank, it works as it should. That's a financially stable country, a financially stable financial system, of financially, or the monetary system is stable. When you go to the bank and you can withdraw your deposits and get credit, and there's folks. Let me tell you, and this I've said this in class many times. In this country, we can walk up and down Fifth Avenue or Seventh Avenue, New York, or whatever, Poughkeepsie, New York, or whatever it might be, get loans and credit cards, and have, there's Wells Fargo's all over the place, and Newark and Elizabeth, and on and on. Right? We can go all these, we have all these financial product options, where in many parts of the world, that's a privilege for the very wealthy, the connected. It's not for the everyday. We've done more. The everyday person in America lives better than most people. Warren Buffett would say this, than most people, and in most parts of the world. The graduate students, I think you guys would maybe agree with that, maybe a little more than the undergraduates. The undergraduates are like me, right? We all Newark, Jersey City, Union City, Bayonne or something, right? We're all from around here, and this is all we know, right? We know, Essex County, Hudson County. That's about what we know. And there's banks everywhere. There's Burger Kings everywhere. You can buy a car everywhere. There's parking everywhere, even when there's not, right? So, but you come from Asia and different places. I think you guys know, right? Our immigrants from the nation of India, you guys know that it's special what we have in this particular country, and just the opportunity and the work and the perspective that I think you have, a foreign student has. Now, Rutgers, I would say 30-40% of my students were Asian, or more, maybe. Certainly a big Hispanic population when I was at Rutgers, but there was compared to St. Peter's, so the graduate students are very international, but the undergraduate is not very international at all. We get the kid from Australia on the soccer team, or New Zealand or something, and a couple guys from England or something like that. And but that's unusual for the undergraduates. More like me, right? We're from right here, and that's all we know is around here, and that's it. But the international, I think students will have a better, maybe a little more of an appreciation for, the enormous resource that this country gives to just sort of, a guy running a landscaping business, or a guy who's a painter, or somebody who's an accountant, or whatever it might be. So it says in modern economics, central banks are usually responsible for the formation of monetary policy and the regulation of the member banks. Today is March 14, going on to 15. And the U.S. central bank meetings are next week, and we were full steam ahead for maybe a half a point interest rate increase, and now it's maybe a quarter point or 25 basis points, or holding steady because of the bank failures. And the idea is that the bank failures in California, the signature bank is New York, and I forget what the third one is, but those are the idea is that that's going to calm the economy down for a bit, so so inflation will still be lower than maybe it was a couple months ago, but still high relative to the last 20 years. Obama, Trump, okay, even Bush, the end of Bush a little bit, where we had very low inflation. Inflation wasn't an issue for a very long time. When I was a kid, we had gigantic inflation, the savings and loan crisis, Paul Volcker, that was our no internet, and we couldn't, believe me, you weren't watching you weren't watching the U.S. central bank meetings and the press conferences or have transcripts like we have today. You didn't have all that. That's the last 10-15 years that it's like that. So it's dramatic. The world has dramatically changed. Mohammed Al Arin, the president of Queen's College in the UK, and native of Egypt, and highly accomplished economist and analyst, and a lot of other things. I'm sure bank president, or university president, college president, also a very accomplished guy, says that we're in a new world now, where deposits are guaranteed beyond that 250. When I was a kid, it was 100,000 or something. It wasn't 250,000. And now it's even past that. So I'm not going to repeat some of the text messages I was getting from family members about why people were getting insurance on their deposits. But it's certainly the customers of Signature Bank, the customers of Silicon Valley Bank, were not just, the everyday person walking around Newark, or the everyday person walking around Elizabeth. That's not who the customers to those banks were. So, we'll get into that at another time. So, central bank is a financial institution given privileged control over the production, distribution of money and credit for a nation or a group of nations. Now, group of nations, all the central banks that I know, Bank of England is for England, but certainly in Europe, it's very cooperative. With the Germany and Italy and Spain, the bigger countries, France. There's a lot more cooperation, and that was the idea of the Europe, because there has to be. In America, we're as big as the EU Union on our own, and the states don't have. There's not a Jersey Central Bank or California Central Bank or Texas Central Bank. Right? There's no regional central banks. There's a federal one, and that's all there is. And they have region. There's 12 of them. It says the next line says there's 12 regional banks. They're each responsible for a specific geographic region. The San Francisco one covers the most, probably, square miles, because the population thins out. Once California obviously is very populated, but once you get away from California, if you look at a map of the central bank regions, certainly the densest area, there's a Boston one, Philadelphia one, there's a New York one. The Fed is in Washington. Philadelphia has one. I think Richmond, there's one. Cleveland, there's one. I don't know if Miami or is it Atlanta's got it. The St. Louis has got a Fed. Dallas has one, so I think that's. And then I think there's one up in Minnesota. Okay, but the San Francisco one is the, maybe not the most people, but just if you look at the map, that's certainly the widest version of it that we have. It's a central bank and monetary authority for the United States. It provides the country with safe, flexible, and stable monetary and financial systems. We hope that's always the goal. It's composed of 12 regional Federal Reserve banks that are each responsible for a specific geographic. I just said that. The main duties are conducting national monetary policy, supervising and regulating banks, maintaining financial stability, and providing. Again, this number 4 sounds very innocent. The list of things that the Federal Reserve does, or a central bank does, it sounds very, but that's a lot. That's a lot. Regulating banks, maintaining financial, for stability is the price of eggs isn't $25 one day and then $3 the next day, and then $50 the next day and $4 the next, the day after that. That's pricing stability. And we have a lot of we have a lot of country, a lot of interests, a lot of commercial activity. There's a Federal Market Committee, and that's you hear talking about the interest rate. That's the Federal Reserve's monetary policy making body, manages the country's money supply. And again, it sounds so simple and innocent, managing the money supply, but that's a big measure. Okay, that's a very big measure that happens, and the impact of everyone working, everyone saving, all the corporations are profitable. So you have all of these things. Everyone's spending, everyone's consuming, everyone's producing, right, all at once. Okay, so I don't know if we really, not that's necessarily a bad thing, but how is that all going to sort of I hate to say it, but eliminating the business cycle? It feels that way. It feels like we're eliminating the business cycle, and then there's a sort of a word for that. And that through history, I don't think that experiment has worked out very well every time it's been tried. The Federal Reserve was established by an act of Congress by the graduate and president of Princeton University, Woodrow Wilson. I still speak his name. Okay, I mean, I don't have a time machine to go back in time and probe what Woodrow Wilson was thinking 100 years ago. I really can't do that, or try to pretend like I understood what he was thinking long ago, or what America was like, or what the world was like 100 something years ago. But he was a Princeton graduate, very accomplished guy. At one time, the international school at Princeton was named after Woodrow Wilson. It was that name for a very long time. I don't have the 1913, but look at this. It was signed a couple days before Christmas. I don't know if we would do that anymore, right? That's too close to Christmas, right? The left would say that, too close to Christmas. But you can see it was a few years after the financial panic. And again, it was just another panic, another bank run, lack of it's the same narrative every single time. Lack of confidence in the system. And again, 1907, 1913, no internet, communication. We didn't have mass communication like we have today. You can turn on Kudlow at 5 in the morning. You can turn on Kudlow at 4 or 5 at night. I think he's doing one of those from his house, because in the mornings he's in like a shirt like me, right? We're doing it from our home office. He's doing the show at that hour of the day, and then I probably goes back to bed or something, and then pops up again at 4 or 5 o'clock in the PM and does another show. It was the only major financial power 100 years ago that did not have a central bank. There were local, there were regional sort of central banks. We had sort of the regional system. Then we had J.P. Morgan, the actual person. J.P. Morgan would bail out the country, and there's parts of the world where there's still these countries looking to a person to bail out the country. We're still looked at as looking at a person, not just at a bureaucracy. The creation was precipitated by repeated financial panics that afflicted the U.S. economy over the previous century. So I have the 1900s, but there was a bunch. I don't want to sit there and presume that the years. Remember, certainly, obviously, the big one's 29, 07 sticks out, but there was a bunch of them. Okay, there were definitely a bunch of them that afflicted the U.S. economy, and there were a lot of things that were panicking in the U.S. economy 150 years ago. It wasn't just bank runs, but that was a part of it. And leading to severe economic disruptions due to bank failures and business bankruptcies. The crisis in 07 led to a call for institutions to prevent the panics and disruptions. That was probably the last bad one until 1929, which we didn't learn our lesson from 1907. So we wanted to try it again 20 years later, and it looks like again, the same. I'm not going to mention the company's name, but certainly one of the main players of the crisis in 2008. That name popped up again with what happened in California. So that's some kind of Kool-Aid that was on 7th Avenue in Midtown Manhattan. That's for sure. That was some kind of Kool-Aid that those folks drank. So anyhow, the Fed had broad powers to act to ensure financial stability. and it's a primary regulator of banks and members of the Federal Reserve System. Which again, we're looking at a very brief, basic summary of what's going on. And I think further down this list, yeah, here's the different places. I almost, yeah, Chicago. I missed Chicago, but Boston, yeah, Chicago and Boston I left out. But the 12 regional banks: Boston, New York, Philadelphia, that's 3; Cleveland, Richmond, Atlanta, that's 6; Chicago, St. Louis is 7 and 8. Then I left out Kansas City, and right there's the other 4 here: Dallas. So Kansas City, Chicago, and Boston. So forgive me, I left out those at the beginning of this. Okay, but I think I nailed the other ones. It acts as a lender of last resort to member institutions that have no other place from which to borrow. And I think what happened relative to '08 is a lot of the banks had to start a fund that would ensure depositors' uh, accounts, that all the banks had to put in some capital into that. And I think, again, I heard that over the airwaves the last sort of couple days, often referred to simply as the Fed. It's got a mandate to ensure financial stability in the system and is the main regulator for the country's financial institutions. So here's the 12 banks, and they're all listed here. I've been to the New York offices long ago. I think I was still at Rutgers at the time. The mandates and duties, the monetary policy goal of the Federal Reserve are twofold: to foster economic conditions that achieve stable prices and maximum sustainable employment. That's Jay Powell's answer to a lot of the press's questions. He goes, "Oh, well, we're here to have stable prices and maximum employment." He says that often. If you look at the transcript, that's repeated over and over. That's his boilerplate answer to many. What are you doing here? What's going on? What about interest rates? Oh, we're here to have stable prices and maximum sustainable employment. And he gives that answer a lot. So, and here's some of the duties into the general area of what the Federal Reserve, or the U.S. Central Bank, does: conducting national monetary policy by influencing monetary and credit conditions and the economy to ensure maximum employment, stable prices, and moderate long-term interest. Steve Forbes, you guys probably don't know. Steve Forbes is a Princeton graduate, managed the school's endowment, and never got paid for it, allegedly, according to him. I was someplace where he was talking about that. But he's a wealthy guy. Forbes magazine, obviously, he's the owner, the heir. He's Trump's neighbor in Bedminster somewhere, and he says the markets will get it right. And to have the government get out of the way. That he was saying that today on one of the on Fox Business about 4 or 5 o'clock today. He's saying that the markets will get which bank to deal with it. It'll reward sort of the useful companies and punish the companies that aren't that useful with employment prices, long-term interest rates. And he says the market will get it right, and the market understands, and the market votes. Okay, so he looks at it like that, but that's not we're not living in that world. We're living in the Elizabeth Warren world where we have to put our hand in the soup, kind of a thing. You don't need to keep stirring the tomato sauce. It cooks just as well without constantly messing with it. Okay, but we have people who want to be, and Trump said it. He says, yeah, again, I'm not here to defend Trump or Biden or anybody else, but I'm just saying, just the quote that he said. He goes, "What are these folks doing in public service to begin with? They're not that useful." So that kind of comment was probably one of the beginning reasons why that his reelection really went off the tracks in probably many different ways. We will also talk about systemic risk. Systemic risk is, again, it goes back to price stability and into banking stability and into the banking system stability, where you walk into the bank and the bank works as you anticipate that it's going to work. That's, a systemic risk is that's not going to happen. And there's you can't get credit, you can't get your deposits, you can't get your loans. The banks aren't open. They're closed, or the line is out the door. Here, this is, and I spoke to, I forget who I was talking to somebody about this. Greek bank crisis 2010. This is what's yeah. Here it is. This is there we go. The lines out the bank. There we go. That thing. Oh, National Bank of Greece, and but that's a line out the door to get your deposits back. And notice these are not 25-year-old people; these are older people, pensioners, retirees. Are they going to, go back into business or get back to work? I don't know. These are certainly not people who are 25 years old. Okay, so this is what price. A banking system stability isn't. That is not a stable banking system. It is. That's why these people are lined up, because the bank is not working as people intended it to work. It's closed. The doors are locked. Nothing good there. Financial system stability, containing systemic risk. Systemic risk is okay. So a bank has a catastrophe or failure or something goes wrong, and then it infects many other banks. Okay, that have similar characteristics. Let me tell you something. Most businesses in a certain industry are not that different. There's a way to do something. There's a way to sell computer services and consulting services, and there's a way to sell. Think of Taco Bell, Burger King, McDonald's. Not that different, right? Not that different. Set of places. There's an assembly line of hamburgers and tacos and chicken or whatever it might be back there, and who makes a better taco, who makes a better burger, who makes a better whatever, a better breakfast, right? The breakfast wars are a big deal. And same thing with banks and banking systems and banks in California. And a student asked me about who the customers were to Silicon Valley Bank. The customers, again, were not just 90% of the, I'd heard this, 90% of the depositors had way past whatever the legal definition of way past is, way past $250,000 in account value in the bank or deposits. So, and they were getting banking services. And again, I'm not going to go through the list of it. I have it somewhere where their asset management services and check clearing and wire transfers. And there's a lot of things. If you're in business, there's a lot of things you need a bank to do that you can't just do yourself. You can't just, beam out $1 million to Europe somehow, or them beam you $1 million. You got to go through the banking system. So financial services playing a pivotal role in operating the national payment system, depository institutions, the U.S. government, and foreign official institutions. So providing, in the role of operating the national payment system, depository, and the U.S. So how the government works, how foreign institutions work, again, with respect to deposits, with respect to national payments, with respect to transfer systems and clearing and settling and all the things that we do that go unnoticed in banking, but or certainly when you don't have them, they're obviously, you can see how important they were when you don't have them. There's seven members of the board of governors who are nominated by the president, approved by the Senate. Each governor serves a maximum of 14 years, which is quite a while. And the governor's appointment is staggered by 2 years to limit the power. So one president can't just, unfortunately with Trump, when he I agree with the Supreme Court picks, the court picks, but he did a lot, and Obama did very little with federal judges and left it to Trump to work on. And Trump was shocked at that, or maybe he shouldn't have been. Yeah, I think Trump is living in the world where the legal system works and the voting systems work how the governmental systems worked how, as we were kids, how it worked, not the way it works today. I think that's really what he was thinking about. So anyway, the law dictates that appointments should represent all broad sectors of the U.S. economy. And these are some of the names. Different people I work with know this guy or that guy, or who knows, whatever, Quarles or Lael Brainerd or something, or whoever. I'm saying this. We'd have to do the bios and all these folks. These are the bank presidents, the regional bank presidents, and Mester and Bostic and some of these folks. Daly, people criticizing her about her thinking on different things. Fed independence. Now, obviously, it's supposed to be independent. But anytime you're talking about money supply and politics, the price. Obama said it. He goes, my popularity went up and down with the price of gas. Okay, so certainly if there's we're about a year and a half away from a presidential election, and really the presidential election season, it'll be in full swing the end of this year, but and certainly by January 2024, it'll be heavily, but it's been since the day after the 2020 election. The next one was pretty much starting. The central bank is independent of to the political class and to the politicians, which is that's like saying your municipal court is independent of the politicians. It's just a fairy tale to think that. So those favoring independence recognize the influence of politics and promoting monetary policy can favor re-election, and the near term will cause lasting economic damage down the road. And Jay Powell says it a lot. He says we're here for long-term price stability, and sound, effective monetary policy will lead a country down that path. And we had that for a good couple decades, and then I don't know. I just think that one group maybe didn't have the power that they wanted, and say, hey, we'll burn the cities down and we'll do this and I'm not talking about the people that we're seeing on video. I'm talking about sort of the people behind the scenes. What's going on here is not as obvious as what you're seeing down in Atlanta, or what you're seeing in Minnesota, or what you're seeing in California or Los Angeles or something. It's not as obvious as that. There's other things going on here that are not so obvious, and who's really behind what's going on in this big sort of reset that's been happening for the last couple of years. I still feel like we're just not. I'm almost of the state of mind that says I almost can't believe what happened with the pandemic. I'm just one of those people that just almost can't believe that's what happened. Anyhow, but critics of the independence say that the central bank, the government, must be tightly coordinated, and the economic policy and the central bank must have regulatory oversight. Well, sometimes you have better cooperation, and sometimes you don't. And I know there's professors that are wandering around, New York City schools saying, "Who needs a central bank?" Well, that I don't, that idea. I don't know about that idea, but it's again considered independent, although decisions have to be ratified by the president and any of the government officials. Somebody's got to sign the checks, right? The treasury's going to release the money, kind of a thing. So it's not a standalone. It's not. And then there's books written about how the Fed is too independent. And there's people take that conversation. So it's subject to congressional oversight, must work within the framework of the government's economic and fiscal policy objectives. Fears over the expansion of the balance sheet and risky bailouts for firms such as American International Group, going back a decade, have led to demands for increased transparency and accountability. Recent calls to Washington to audit the Federal Reserve could potentially undermine the independent status of the central bank, and the Fed is considered to be independent because the decisions do not have to be right. The central bank makes its own decisions theoretically based on the economics, based on the math, based on the experience of the scientists that are there. Okay. But again, you can have a conversation with somebody about that, and what the sort of the you can have a conversation with somebody about that, and is that what's really happening, and did Trump really influence things? Is Biden really influencing what's going on? That kind of a thing. But to me, I've watched a number of those press conferences. It looks like they're really having a sincere, good faith debate over what's going on. It says the Fed's main source of the Fed's main income source are interest charges on a range of U.S. government securities that is acquired through its open market operations, and we could go through what open market operations are, just buying and selling of these financial instruments like any other commercial bank would do. Other income sources include interest on the foreign currency investments, interest on loans to depository institutions, fees for and check clearing and fund transfers, fees for those particular services provided to the institution. So it says other sources somewhere in here. There's sort of what the revenue or the income of the Federal Reserve is, and that's like any balance sheet or income statement of any company, like Home Depot or Walmart or whatever. It's a business. Okay, it provides services, it charges fees for those. How do banks say the interest on deposits, interest on loans, or whatever it might be? Okay, or results of transactions in the securities markets. The gains and losses from that. Okay, it's like any other bank and has the same. It has the same structure as any other for-profit bank would have. It says after paying expenses, the Fed transfers the rest of the earnings to the Treasury. Okay, that's how. Now, actually, I was going to maybe do these all today, which I'm not. So we'll do finish these notes, and we'll work on we'll do one set of graphs, but I'll do we'll do 3 videos, but so break them to 3. I'm just looking at how long this is taking. So we'll break it up into 3 pieces. So. But it says, after paying expenses, the Fed transfers the rest of the earnings to the Treasury. It says the Federal Reserve payment system, commonly known as FedWire, moves trillions of dollars daily between banks throughout the United States. U.S. transactions are for the same-day settlement. And again, we're not going to go into clearing and settling and what all the meaning of that is. But clearing means that we're lining up the 2 points of transfer between the source of funds and where they're headed. The settlement is the last piece of the puzzle where we're closing the transaction. So clearing is we're pointing people at one another, and settling is we've pulled the trigger, and what needs to happen happens, kind of a thing. It says the aftermath of the 2008 financial crisis, the Fed paid increased attention to risk created by the time lag between payments made early in the day and when they're settled and reconciled. Large financial institutions are being pressured by the Fed to move or to improve real-time monitoring of payments and credit risk, which has been available only on an end-of-day basis. And actually, the meeting that sets the interest rate for the money supply is called the Federal Open Market Committee, which our final exam is going to be based on. So this is the Federal Reserve versus the Federal Open Market Committee. And what do we mean by this? The Board of Governors is responsible for setting reserve requirements. That's what the board, and also the Board of Governors has these meetings. Also, the Federal Reserve has a Board of Governors that conduct this meeting with the appropriate economists in the room. It says this: the amount of money banks are required to hold to ensure they have enough to meet student sudden withdrawals. It also sets a discount rate, which is the interest that the Fed charges on loans made to financial institutions. And so the discount rate is commercial banks borrowing directly from the Fed. The federal fund rate are the banks lending excess reserves to one another. Not it's commercial banks. Federal fund rate is commercial banks. Commercial bank discount rate are commercial banks between the commercial banks and the central bank. And this is higher, and it's just, banks are discouraged from using this sort of lever or this option when you could get the funds from a commercial bank, from another commercial bank. So the Federal Open Market Committee, on the other hand, is the Federal Reserve's main monetary policy making body. It's now again it seems like it has again a very good faith, academic scientific discussion as to what are we doing policy wise, and let's explain this and why are we doing what we're doing, and going through the details and explaining the sort of the operation to the public. It's responsible for open market operations, including the buying and selling of government securities. The FOMC includes a board of governors known as the Federal Reserve Board, the president of the bank, the Federal Reserve Bank in New York, and the presidents of 4 other regional banks. So it's the board, the New York Fed president, and then on a rotating basis, a couple other regional Federal Reserve of the other 11 regions. A third of them show up for the meeting. The committee is responsible for monetary policy decisions, which are categorized into 3 areas: maximizing employment, stabilizing prices, and moderating long-term interest rates. So if we set up the country where we have a lot of volatility and the financial markets are moving around all over the place, interest rates are moving too much, certainly, inflation's, can be out. And we've seen countries in Africa and South America where maybe, I guess, it not being as well thought out that what the policy may be, is the result of it is not really effective or desirable. If you start printing money and prices are all over the place, and you're trying to pay off debt, you're devaluing your currency by doing that. And so there's a lot of dangerous things that can happen. I don't want to say unintended, but certainly there's a lot of bad outcomes that can happen with money printing and interest rates. And that's why you see the movements in the federal funds rate are very minor. If it's a half a point or 3/4 of a point, that's a big deal. It's generally either holding steady or it's a quarter point change or no change at all for a very long time. Central banks across the globe, including the United States Central Bank, have come to use tools called quantitative easing to expand private credit, to lower interest rates, to increase investment and commercial activity through the FOMC decision making. Now, again, Rubini and a lot of people, Rubini is the NYU economist, would say, we were in a very unnatural environment with such low interest rates for such a long time. It was over a decade. And the idea was to stimulate the economy during a recession. And we did not have a recession for a good decade or so. And then the virus came and really turned the world, and it was worse than a recession, really turned things upside down. It says quantitative easing is used to stimulate economies during recessions when credit is scarce. It was used during and following the financial crisis, for example. There are some questions here. What does it mean that the Federal Reserve Bank is a central bank? Who owns the Federal Reserve? Does the Federal Reserve print money? How does the Fed set interest rates? Does the Fed collect taxes? So certainly the central bank is only responsible for monetary policy. They do not, and bank oversight. They do not collect taxes. That's the IRS does. So there's most countries. That's small. Most countries. It's as far as I know, every country that I deal with, those are separate governmental agencies. How does it set interest rates? It's certainly there's a target. The ideal inflation rate is considered 2%, which we had there or thereabouts, which we've had for a very long time. For most of the lives of my undergraduate students, you only lived in a world where there was about 2% or less inflation. Inflation target is based on the belief that long-term economic growth is best achieved by maintaining price stability, and price stability is achieved by controlling inflation. Inflation levels of 1% to 2% a year are generally considered acceptable, but 3 is greater. While inflation greater than 3% is a danger zone that could cause currency to become devalued. The Taylor rule is an econometric model that says the Federal Reserve should raise rates when inflation or gross domestic product rates are higher than desired. So I guess that's what we're doing now, right? I guess that's what we're doing. Does the Fed print money? No. It says the Treasury Department issues coin, but the Fed prints and manages paper money. Yeah, okay. So the metal money is the Treasury, paper money is the Federal Reserve, or which are known as Federal Reserve notes. The currencies are dollars, $5, $100 notes. The largest denomination ever issued for public is the 10,000. I've never seen that. I've seen $2. When I was a kid, it was a big deal of a $2 bill. But public circulation was a $10 note, was a $10,000 note. Who owns the Fed? It was created by an act of Congress in 1913 to serve as the nation's central bank, and the Board of Governors is an agency the federal government reports and is directly accountable to Congress. That's who provides oversight and says, what does it mean that the federal bank is a central bank? It's a financial institution that's responsible for overseeing the monetary policy and policy of a nation. And central bank regulates money supply and sets national interest rates. And central bank also enacts monetary policy by easing or tightening the money supply and availability of credit. Central banks seek to keep the nation's economy on an even keel. Okay. So there you go. So you had your lecture on this part of it. You had the Federal Reserve lecture. What I intended to do was maybe work out all of these, but I don't think time-wise that I don't want to rush through them either. So and I had 3 graphs that I wanted to make. So what we'll do is I think we'll just graph the 10-year right now. We'll do that in this video. We'll just graph it, and then the 2 and the 3-month and the 2-year, we'll talk about the Treasury, and then we'll talk about the difference. So we'll break this up. We'll break this up into a couple lectures, if you guys are okay with that. Man, that's not what I wanted. I'm just reorganizing my lectures here. So this was the Federal Reserve version. So Federal Reserve System. And the 10-year note. This is U.S. Treasury 2-year note. This is U.S. Treasury and Fed, and this is 3-month bill. There's part 2, 3. You got to organize what you're doing, right? 92, 93. Okay. Okay, so we have the 10-year here with some of the graphs from the S&P 500 that we worked on last time. A 3-month security, 2-year security, and a 10-year. Okay, so and now the difference being these are going to be percentages as opposed to these are going to be percentages as opposed to just index numbers, and we just want to make sure that we can treat them how we're supposed to treat them. Okay, I will make a graph, and certainly the 10-year is very important. It's very important. Okay, so this is the 10-year note, the 2-year note, and the 3-month bill, and then the bond is the one, the 30, the bonds are the past 10 years. Okay. All right. St. Louis Fed is where we're so yeah. So now looking at this, so yeah, this we're not this we're not gonna worry about this right now. Here with that. So yeah. Okay. So we spoke the Federal Reserve System. We're gonna hit the 10-year note. And then tomorrow, not tomorrow, but we'll do treasuries, we'll do the 2-year, and then we'll look at the differences, and we'll have experience with these graphs, a couple different times. Now it says right here where the data comes from. So let's do this. Copy, and let's go to Fed 10-year. And this, yeah, the data's here, and you can subtract when you hear the yield curve and all that stuff. You're subtracting the yields, and we'll get to that. We'll get to that. Obviously, this is recessionary, and the yield plummeted for several reasons. A lot of capital piled into to treasuries, and the monetary policy was set, or the interest rates were set to a lower number. So it was a combination. So in other words, as you bid up the prices of these debt instruments, if it's more expensive to get the fixed payments, you're reducing your yield, you're reducing your return because you're paying more to get the same dollars. And inflation's not really supposed to not that it's not supposed to come into this. We generally don't think about that too much. Okay, but certainly inflation has a real effect. But when you're sort of doing the math, it's done nominally, the math on this. Now, this goes back, I want to go back 5 years. So what we'll do is we'll go back to 2018, January 1st to the latest numbers that we have. So you can see Trump years, you're still 3% or so, and then it fell off, it fell off a cliff. Too high is no good either. Too high means there's a question of confidence, or capital is leaving these instruments, and that's why there's little demand, or the demand is lower, and that's why you get a better yield. So again, but if you've got the time to wait the 2 years or the 10 years or the 30 years or whatever it might be, then you're going to be okay. Okay, but the problem with the Silicon Valley Bank is that they had to sell sort of mid contract with these debt instruments, and the demand for a lower yielding or the demand for a lower coupon arrangement wasn't as high when there's higher yields out there in new issuances. That's what the problem was. So they had a realized loss that was too big, and that those banks could have been saved if capital came in. There was capital on the sidelines, but we went through this drama of sort of a bank failure, or perceived bank failure. They're still in business. They're still open for business. They're still trading. And there was a big bounce back in a lot of the share prices of the equity to those companies. So that's something to keep in mind. So anyhow, you're at the St. Louis Fed right now at their data website. So you change the dates here, the 1st of January 2018. So 18, 19, 20, 21. Yeah, so we'll get the last 5 years. This is 10-year constant maturity quote on an investment basis of U.S. Treasury securities based on the market demand, based on the US dollars that people would pay for these instruments, and the yield is computed. Now, we're not going to go through the yield computation in this particular course, although we did similar math at the beginning of this. All that time value of money math does play a role in that, but we're not going to necessarily go through how to compute the yield on a bond. But it's the rate of return is what it is. So it's it's rate of return, or IRR, or whatever. What is it? IRR, the expected return, or the return on investment, or whatever, however you want to look at it. But you're solving for the interest rate is what you're really doing. You hit download, and we have and before we do this, we want daily, weekly. Now daily, this is going to be 1,000 pieces of data, right? This is 1,000, and you can see you have many choices. You get monthly readings, you get weekly readings. Let's do daily. Yeah, let's do daily. So, and we'll do down the frequencies, and we'll download it into Excel. We'll take a breath here, say novena as this thing is downloading. And again, these are percentage returns, but we're going to treat them we're not going to treat them as percentage. We're going to just treat them as if they're numbers. Yeah, and you open it up from your download folder. Get rid of your edit there. So there you go. Now, painfully, here, let's quickly go through the again, you can put on a little music when you do this or something, but now, the Federal Reserve version of this, you gotta go through. See, we have all these NAs, and I think I've said this before. You gotta take out all the Christmases and 4th of Julys, and so just it's a little tedious. Like I said, there's another way to do this, but, it trains you. It gives you some discipline to do something. Because what you'll do if you don't remove these, you'll have these funny dips in the graph. They're gonna be, difficult to explain to whoever it is you're presenting this to. And folks, I'll tell you, I do a lot of pictures. I do a lot of my screenshots, and yeah, I send my guys PDFs. But in the analyst world, when you're trying to make your point about something, you need a good graph, and you really need some, you need some good stuff. You need some good stuff out there. You got to get to the point. Is what I'm trying to say. That's Labor Day, whatever that is, Halloween or something, right? This is voting day or something, election day, right? This is Christmas, first of the year. I click on I like to click on the rows like this and just get rid of them like that. I'm hitting control and grouping them. So I don't want to group everything in between, right? Christmas, New Year's, President's Day, or whatever it is, right? Like I said, folks, a little more patience. Almost done. Yeah, that's it. So what we do is now highlight here, shift left arrow, control up arrow, and arrow down to the beginning of the date. So we're going to say copy, right click and copy, and you can drop them off. I don't know why I jammed it up like that. So here you can just do this and say paste just the values. Okay. Now these are interest rates. And here you can do this, shift control down. And I think we have a few. We went a little further with these. You're going to clear out the fill. And what you need to do, again, you're dealing with 1,000 pieces of data here. You're going to take this. You got to format these. So this is control, and I'll explain this little counter here in a second. But you're going to take these two here. You're going to say copy and shift right, and then shift control down, and then you'll do paste formatting and hit escape. And there, see how this is now? The font is blue. These are percent. Now look at the yields. Now certainly we'd be very interested. Recently, what happened a couple days ago, right? We're going to be interested here what these are going to look like. So we're 3.5 now. So that means capital piled in to these instruments. We were at 4 or near 4, and in the treasury world, that's big movements when you get to those numbers. Now, unfortunately, for better or worse, we have a bunch of these borders here, but we're going to just sort of scroll up, and we could have arrowed up too, but we're just going to scroll up. And what you want to do is every month you sort of want to cut these and sort of in half a bit. And there's a way to do it quickly, which is that. You can come up here and get rid of those borders, no border. And now it's going to be a sort of an Excel exercise a bit. And actually what you can do, now you got rid of all the borders here on the number line. And actually here, let's look at these numbers. It's always important when you have data to know how many pieces of data that you have. So right there, control 1. And again, you got to use, this is number, right? I centered it. The font was, I could use a black font. Okay. And the size was a 9. Anytime you have an index or a date, you can make those. So here, the data point is font 11, the date is 10, and the index is 9. So you have lesser prominence of these, because this is what you care about. You care about this percent. This is as a percentage. So again, this is the market yield on treasuries of a 10-year constant maturity note. So in other words, based on what people are paying for it, when you do the math, that's what your annual return would be for, let's say, theoretically say for 10 years. Let's say you bought this on the day of issuance and you're going to sell it, or you're going to turn it in, or you're going to close out the transaction on the day it's retired, basically. And what you're going to want to do, and see, it says index change, and actually that may not be the best terminology. Yeah, we can do, it might be better, and then rate percentage change. That might be better. I think I have to go. I have a feeling I have to go through a lot of these and fix them. I have a feeling I'll be doing that. Yeah, if you guys will just bear with me here. That index, yeah, these aren't indices. This is a rate. When you go back and look at it, that's a rate. That's a rate. That's a rate. These are all rates. That's a rate. Currency, dollars, Fed funds. That's a rate. And some of these are, that's inflation indexed. This is CPI, commercial loans, 30-year mortgage. Yeah. So there's, and then hit escape. So yeah. So here, let me just save this so. And the data, you don't really need the data any longer either. That you don't really need. Okay, so you have all that. Okay, so, and now we're going to make a graph of this. And actually what we can do, so it says and daily, we could almost use this in a sense. We're going to go back to that in a second, making the graph, but these are the rates. And like I said, what you should do is, now we're going to work out the method, but you want to put borders in like every month. So here, let's do this. The rate change is just the delta. That's just the difference. So you went down, a 50th of a percent, or 200ths of a percent, and you can see that the movements are very small. Okay, you do not have large movements. Control D. You can see how the rate. So here the rate went down, 1500ths, and it went down, 1/100th change, and didn't change at all. And you could expand these out to more decimal places, but these are just numbers. Okay, it's represents a percentage, but it's a number. So don't turn it into a percentage because you divide it by 100 and you're causing yourself some confusion there. Okay. So you have the rate change, and then now I'm saying you have the rate change. Now you want the percentage change, and the percentage is that delta divided by the previous uh, yield. So you can see it's about almost a negative percent, plus or minus a half. So you can see what these look like, and then I'm saying shift down arrow all the way to whatever March 13th or whatever it was. Control D. And you can see the percentage the last couple of days, 5%, 4% changes, 2% changes, 3% appreciation. The smoke signals were coming, some of these spots here. This was -4, but it's uncommon to see those kinds of numbers. That's uncommon to see those kinds of numbers. So what you would do is you would generally want to put a bottom border. Now I'm not going to do them all, but every month you want to sort of break this up a bit. And I'm going 2 places out. And what you can do with this, and you could even do this, Alt HB O, right? You can just use the keyboard shortcuts if you wish. Okay. And actually, what I want to do here, get rid of shading. And we'll do some up here too. We did a few. We did a few. And now what we'll do is, you want to find average, the average rate change and the average percentage rate change is what you want to be able to find. So this is equal to average parenthesis. Hopefully we spelled it right. This is the rate change. You could even increase this if you need another number there. And this is copy, paste. Like that. You have a percentage change. Okay. You can see for that month it moved about 0.5%. And now I suspect if we take these and we come down here, these are going to be, now we have to do some adjustments here. Bring it there. You have to make sure, because not all the months, see, they're off a bit by a day or plus or minus. And this would be 13.3. 1286. 4. 8.58 versus what we had here. Oh, okay, not that different. So let's go back a bit. 7. You can just grab the corner, which is sort of the terrible way to do it, but it does it quick, and it gives you good. All right, so not that different, but all right. But I'm saying, but certainly down here, if you took some of these averages, you're going to be very skewed, even if it's just this far. Yeah, minus double the average rate of change. If you looked at that, right? Because you had the 5 and the 4, and you had the almost 3% change and a positive 2% change. Okay, but you don't have the whole month yet. Like I said, so you can go back and work on all of those. Okay, you can take these two, copy. I'm just doing a few here as we're sitting here looking at it, right? Actually, what you need to do also to give yourself a good with your eye, Alt HB bottom. Want to go through yourself and make sure that you're. I want to make sure what you're doing here. Okay. Like I said, you'd want to go. I'm not going to do it all in the video right now, but you'd want to go through all of these and just make sure that check your averages and what things are looking like, and that kind of a thing. There. Yeah, and like I said, computer science goes far for you, but there's still some manual work that you have to do. But like I said, you'd want to go through and partition all the months and take the average changes and the average percentage changes and all that stuff. But this is just a yield. Okay, all this is a yield. So now we had the graph last time, right? And actually what we'll do is we'll go through the steps. I don't want to just keep repeating myself here. So the next two we'll copy and paste the graph, but here we'll say shift control down arrow. That's all your yields. We'll say insert, scatter. We'll pick that. Pick the layout. And move this off a bit so you can get to the dates. Select the data. Edit the X is so here. Shift control down, which is right there. And what is this thing? This is the 10-year. Security. And you can take this ledge and go to layout ledge and give yourself instantaneously more room. So the legends on the top now. All of a sudden, this looks a lot better. And let me see. What do we call these graphs? Oh, it's the percentage yield. I call them the percentage yield. But okay. Or market yield. Market yield is good. Yes. This is simply days that you measure. Okay. And this, and here, if you don't mind, I'm just gonna instead of typing all this, I'm just gonna borrow this if you don't mind. And you're gonna have to type it, unfortunately, but I'm just gonna borrow this. When you lose your graph, that's how you find it. You just shrink the screen a bit. It's at the bottom somehow. Okay. Obviously, we have to fix that. This is 18. This is 12. And we're going to make this bigger. You're going to cut this. You can find the rest of your graphs up here. I was going to size everything just right, too. Nothing to be sized up just right. You can make them a little bit bigger. And like I said, when you're going to PDF everything, then you can sort of figure out, how big that you should make them, and you'll get a sense of that, how big to make these. Yeah, we say the yeah, we could say the volatility. I'm just going to graph the yield, but you could say the volatility of this also. Okay. Yeah, 10 years. And this is to March. And so when you reuse like we just did, you got to make sure that's March 18. Right, you want to make when you reuse, make sure that you know what you're reusing. Put a border around. Oops, that's fine. Put a border around it. You want to put a border around this. You don't need these grid lines. None. You can read across. Okay. You can do a nice fill. Nice white fill or gray one like that. And you can format the plot area, shadow. Okay. Almost done. The dates, you want them smaller, the percentages smaller. And let's see how many days they're doing 500 days in between or so. Let's see what we'll get with 30. Yeah, but here you can do this. You can format the axis, alignment, 175. You can do that. Okay. And do 60 days. A little bit better, every 2 months. There's your yield. Okay, as you can see, so what we do? We had so you're your own Bloomberg terminal. It's really what you are. That you're your own Bloomberg terminal. So, okay. And like I said, so we'll go back. We'll deal with treasuries. Um, you're seeing how to you're measuring the volatility of these securities is what you're doing. Like I said, but you want to go through everything here, and you want to come all the way across like this. All right. So you put on some music, or you put on the Yankee game or something, right? And you go through all this. A little bit of focus. It'll sharpen your mind to go through all these, right? Like this. Right? You got to go through all these and set them up like this. And again, who knows if there's some way to do it that's not so labor intensive and manual and all that. There might be some way to do it. You guys are always showing me that different ways of doing things. Save your work as you go, and there you go, and that's it. You don't need the data once you get the data from the never work in the Excel that's downloaded. I learned that a long time ago, right? Yeah, and what I did was all this information up here, I cut and pasted and cleaned up the formatting here, Federal Reserve St. Louis Bank and the website and the economic data, the yield, and like I said, and you can. This is a little crammed for me, so there. I think it might be a little bit better. I don't know why it's had it so. You know what it is? I think I was referring to some other piece of data somewhere. Yeah, even this one I sort of opened it up a bit. But now we evened up the dates a bit. So when you have a lot of data like I do, and like I said, I'll tell you, folks, I have my own little Bloomberg terminal. I keep track of the S&P and all the economic indicators. I'm showing you guys how. Again, if you ever do this for a living, you're going to want to keep tabs on what's going on with the treasuries and all these things. So what we're going to do next video is we'll talk about treasury specifically and the U.S. Treasury and the differences between them, and we'll do a couple more of these graphs. But the difference being. Is that we'll take a little bit of a shortcut now that we've gone through it once. So the 2 year, the 3 month aren't going to be very different. Okay, so we can go through all these and actually, as I'm sitting here with you guys right now, if you guys don't mind, here we'll just. date, which is right there. Here. Yeah, I'm just lining up everything here, if you guys don't mind. There you go. Okay. So we opened this up a bit. Just open up here and there and save. Okay, so like I said, you want these things set up well. Okay, you want this stuff set up well. But there you go. There you have the graphs for this, and then you have, and like I said, it's slow. You do want a couple of these a day. It builds, very well. So that's the market yield. Okay, on the treasury, and obviously it's higher right now for a combination of reasons. Okay, it's higher right now because there's confidence that the United States government will, and it's a new world doing stuff like this, but the United States government will backstop, will ensure uh, depositors, and certainly in banks with very high, high net worth depositors, that the deposits will be insured, and that the capital's flowing back into equities. All right, so there's a demand for that. So as the capital flows back into equities, it flows out of bonds, and there's just some feeling that interest rates will appreciate, but not as much. So there's all these forces at work, pulling capital from one opportunity, pulling them out of debt into equity, out of equity into debt or into something else, and all the indicators are sort of just everything's just sort of all the gauges on your car, right? You drive your car, there's a temperature and the engine temperature and the outside temperature and all sorts of temperatures out there. Folks, it's always great spending some time with you guys. Let's get this posted, and we'll see you on the next video, probably Friday. Okay, thanks.